Hey Dave, how you doing today?
I'm doing great, Nick. How are you?
Fantastic. It's
Fantastic.
a great day to be a financial planner today, I've decided.
Every day is a great day to be a financial planner, except for like some random Mondays in
Oh.
October of 1988, stuff like that. But otherwise,
Yeah. There you go. I love it. So interesting topic today, Dave, and we are talking about the four, although I'm sure there's more than four, but the four that we decided principles for retirement investment success and really investment
yeah,
success in general. So tell us a little bit about that.
Yeah, so this is our attempt to distill down to as simple a form as possible the things that we think you need to know and understand to be a successful investor. And it's
Mm-hmm.
it's it's not meant to be a primer in how to pick stocks or how to build a portfolio, but just some basic nuts and bolts things to understand and keep in mind so that you can survive when the market twists and turns and throws you loops and you think that things are coming apart.
Yeah, it's interesting. This might come as a shock to you, Dave, but I was listening to a podcast the other day on investing.
yeah,
And what's interesting is this was talking a little bit about simplifying things. And
Hmm.
I think one of like the big problems is when it comes to things like investing and numbers, we have a tendency to think of it as so complicated and
right.
complex that we need some, miracle strategy or there's a lot of things going on. And really a lot of times you can just boil it down to some pretty, simple principles
Yeah,
that if you follow, you're going to be successful. Will you be the next Warren Buffett? Probably not, but will you get the return that you need to do the things that you want? Probably.
exactly. This is just meant to give you some basic principles to keep in mind so that you understand what your advisor is doing or what
Mm-hmm.
your fund managers might be doing or why
Mm-hmm.
you made certain choices in the first place.
Yeah.
Um, but yeah, you can, if you, I guess the way I would look at it is if you understand these basics, you can then decide how much more you want to know
Yeah.
and go from
Mm-hmm.
there, right?
Yeah. I love that. So what's principle number one? This
So,
the
so
suspense is killing me.
so the first thing, and this is so basic, but over the long term, investing is not gambling or luck. The market grows over the long term for real reasons.
Yeah.
The reason we think that's important to enunciate is because a lot of people that are just starting out view it as a crapshoot, right?
Yep.
I'm
Mm-hmm.
just, the market's completely random all the time, and it's just dumb luck if this works out for me.
Yeah.
And that's not, I guess what I'd like about this is to differentiate between things that do not have intrinsic value, like
Mm-hmm.
gambling or some of the esoteric things people think of as investments that we've talked about a lot. But when we're talking about stocks and bonds, right, there's real value there. It's based on something. It's not just a made up number. It may
Yeah.
be a good number or a bad number. That's a whole different discussion.
Right.
But over the long term, the economy grows and the market grows as productivity increases, as new technologies come online, as equipment wears out, as
Mm-hmm.
people discover new great ways to do things and new products to try to make money with.
Yeah. Well, and we have gotten this a lot, and that is where people think that, like you said, stock market investing is a gamble. And in fairness, if you look at it in the short term and you're just picking
Well,
stocks, it really
right,
is, right?
right. And so that's principle number two. Okay.
Mm-hmm.
In the short run, any given day, the market is unpredictable and scary and really is kind of a crapshoot because you
Yeah.
do not know what is going to happen on any given day.
Right.
And to differentiate, when it's one thing to look at 10 years of
Mm-hmm.
market data and say, okay, over the long haul, the market grows for these good reasons. In the short run, I can't tell a client what's going to happen tomorrow or
Right.
Friday or next month. And so those two things are not mutually exclusive, right? It can be random in the short run, but a pretty sure bet in the long term,
Right. Yeah.
you know. And that's those are the two, basic pillars from my point of view.
Hmm. Yeah, and I think a lot of it kind of depends on where you're getting your personal financial planning information from, right? Like if you just turn
Hmm.
on Squawk Box or something like that, you're going to hear a bunch of raving lunatics talking about
Right.
what happens in the next five
Well,
seconds.
so you and I both get media requests, right?
Hmm.
And which is where members of the press reach out to certified financial planners and ask us to comment on things that they're writing stories about. And every day, well, we get what, a half dozen a day? I would
Yeah,
say four
probably.
or five out of those half dozen are something along the lines of, this happened today. What do you do now with your portfolio?
Right.
You know, and I just delete those now because I got tired of writing, you do the same thing you do every day.
Yeah.
which is, for remember that the short term doesn't matter. We
Right.
can't tell you what's, in the short term the risk will always be real,
Right.
and in the long term you stick to the principles.
Yeah.
So
Yeah.
just remember, day to day headlines drive the market up and down. Volatility is normal.
Yeah.
That is part of being an investor. The situation will always be scary, it will always be hectic,
Hmm.
but remember, the markets are digesting the news almost instantly.
Yeah.
And so we can't, so that's part of this principle too, is that you can't time these things.
Hmm.
It's never going to feel like a good time to invest. We quote Dr. Daniel Crosby a lot on this show, but he reminds us that corrections are as regular as your birthday. If you
Yeah.
look at the stock market history, a correction being a 10% drop in value happens on average once a year.
Hmm.
So just, be ready. That's part of it.
Yeah, absolutely. And prepare yourself for that
Right,
inevitability in your planning, right? Like,
right, right. So how do you hold these two opposing ideas in your head at one time, or in your portfolio at one time? You hold
hmm.
cash for the things that are going to happen in the short term because you can't afford to have those go up and down in market value and be
Yep.
random. And you invest in the long term things because you need the return on those to beat inflation and to grow with the
Yeah.
economy.
Yeah. An interesting point that I want to make here, discuss with you, Dave, is when we're talking about retirement investing. We have a
Hmm.
lot of people that get to that like magic finish line of retirement, and then all of a sudden nothing is long term anymore, right? Like
Right. Oh, I'm
everything is short
65.
term.
Yes.
Yeah, right,
Yes.
exactly.
Yes. Yeah.
So,
Yeah.
and I think it's just an interesting dynamic of like your mind playing tricks on you. Like when we're
Hmm.
running plans out for people, when we're looking at statistics on how long people live, the reality is 65 is young, and you probably got a good, for
Right.
sure, probably 20 and potentially 30 years left. And that's still pretty long term, right?
Right. Right. Barring the accidental things that we can't do
Hmm.
anything about, or the flukes of health that you can't do anything about. But for
Right.
your average person is going to have an average life expectancy, which
Yeah.
puts you out into your 80s easily, and then
Right.
a good chunk of people are going to outlive that.
Yeah.
So yeah, so short term is relative. And
Hmm.
and none of this is to say that we would, like, you buy stocks and you stay with the same allocation all the way throughout retirement,
Right.
or that your allocation at any point in your life needs to be 100% stock.
Right.
But understand that the part that is in the stock market is going to be volatile and going to be up and down and random in the short run.
Yeah. Yep. It's the kind of the cost of doing business when
Cost
it
of
comes
doing
to
business.
investing, right?
Yep, yep. Lots of Pepto Bismol.
Yeah. So what is principle number three, Dave?
So principle number three is that, as scary as the short term might be, the good times and the growth periods in the market have always outweighed the bad times and made it
Yeah.
worthwhile. And we've got a
Hmm.
really good chart, and all of this is based on an article in that I published in the Retirement Daily a couple weeks ago, and we'll link to that. It has the charts, but essentially, the average bear market runs about 14 months with 36% declines, but the average bull market runs almost 6 years with a
Yeah.
cumulative return of almost 200%.
Yeah.
So, you know, if you can ride out the dips,
Yep.
the troughs, some of
Mm-hmm.
them are very painful, no doubt.
Yeah.
Nobody wants to see a 36% decline, but if you double your money, during the good times, you'll make up
Mm-hmm.
for that.
Yeah. It's so, it's such human nature, it seems like, to focus on the bad things or and worry about the
Hmm.
bad things and forget to celebrate the good things, right?
Right, 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 right.
And this is just like true to that point of, yes, there are bad times. There's going to be bad times, but
Oh yeah,
also there's some really good times. So don't forget about those because that's what really drives the
right,
growth.
right, right. And if you invest based on the bad times, you're probably going to be pretty disappointed later
Yeah.
on.
Well, more often than not, you're going to be, the market goes up. So don't forget that, right?
Right, right. And so, bringing us to point number 4, you can't avoid investment risk and expect higher returns.
Mm-hmm.
The two are related, they cannot be separated.
Yeah. No free lunches, right?
Right. So, at its most basic, the more risk you take with your portfolio, the higher we expect your return to be over time.
Mm-hmm.
You can reduce your risk, you can hold more in cash, you can mix more bonds into your portfolio, but you've got to expect then that your return will be lower over time.
Right.
And you will not get away in the long run with trying to time those events. You may be lucky, but
Mm-hmm.
that risk reward will hold true. If you reduce your risk because you think things are bad, you're more likely reducing your return too because you won't time getting back into the market correctly.
Right. Yep.
So, risk and reward are part of it, and
Mm-hmm.
you can reduce risk by having a less stock-based allocation. You can also outsource some of that risk to insurance companies,
Yeah.
but those things come at a cost that are going to
Mm-hmm.
diminish your returns.
Yep.
And so while you may not see as much volatility in your portfolio and think you're getting ahead, you will more than likely end up in the same place as if you had
Yeah.
just invested conservatively in the first place.
Right. Well, to kind of further that point, yeah, there's nothing wrong with being conservative, right?
No,
Like, we constantly hear, like, people that think they need to get a better return. Like, I know people that are perfectly happy living their lives with, pretty small returns, not taking a lot of risk, but still able to do all the things they want to do
right,
and enjoy life.
right.
And, one of the things I love saying around here is financial planning is not a math problem. As much as you might want to distill it down to one, there is math involved, but it's
Yeah.
not just a math problem, right?
Or you could look at it that it really is kind of a math problem with 3 basic variables. How
Sure.
long are you going to work? How much are you going to save? And how much do you need to spend during retirement? I guess, and then the fourth would be, how much risk are you going to take with your portfolio? And if you're going to take less risk, then you need to at least plan to save more or spend less.
Mm-hmm.
And if you're
Yeah.
going to take more risk, you may be able to get away with then saving less or spending more. With our clients, it tends to be that they save more and take at least a moderate amount of risk, which means that they can probably spend more than they think they can spend.
Right. Yeah.
You know,
Yeah, it's definitely one of those. I just feel like people get so wrapped up into, well, I have to do this or I have to, go out and get the best returns or grow my net worth, and
hmm
that's the math that we need to kind of try
what's
to
the
avoid.
benchmark doing? You know,
Yeah, exactly.
how much should I have if how much do I need in my portfolio based on my age? The Wall Street Journal says I need 2 million before retirement. How do I get there?
Right.
Well,
Yeah.
in that sense, no, it's not a math. It's not a math problem. It's a you problem.
Yes. Yes. So where do we go from here, Dave? How do we put these principles into action?
Well, as you said, there's nothing wrong with being conservative. So choose an asset allocation and a contribution plan for your savings that you can stick with and ignore the markets. And if
Yes.
ignoring the markets means holding more in safe assets so you don't worry about it as much, then that's fine. It's a conscious choice.
Mm-hmm.
Um, but make that dichotomy. I like to think of having two basic buckets while you're saving for retirement. There's your long-term savings that you don't need to think about and worry about. You make decisions and leave it alone. And then there's your short-term savings, which you don't have to worry about the markets, and you just try to, make a good interest rate that's competitive, but know that
Mm-hmm.
it's liquid and safe.
Yeah. Yep. No, I love that. And, ignoring the markets sounds easy, but it's hard to do because it's
Yeah,
not necessarily just the markets, right? It's your neighbor, it's your family, it's your
right,
friends. Like,
right.
just, as Morgan Housel likes to say, just remember they're playing a different game than
They're
you.
playing a
So,
different game. Exactly. We could talk a long time about how to deal with the news, and I think we may need to do that sometime here in the next month or two, ramping up to election season and other things we've got going on in the world. But you know, we have a tendency to hear headlines and think worst case scenarios,
yeah.
and just pausing and thinking about these things when you hear them and
Mm-hmm.
remembering that the worst case scenario and the best case scenario are equally unlikely.
Yeah.
The truth will tend towards the middle, and
Mm-hmm.
the world has seen a lot and survived a lot, and the
For
markets
sure.
have seen a lot and survived a lot. So
Yeah. Yep.
um, do your best to tune it out, and when you do hear bad things and feel emotional, if you've done the first couple steps and made sure you have enough in safe investments, then you're a long way towards being able to forget about what's going on with your long-term retirement account.
Mm-hmm. Yeah. Absolutely. Well, that is great advice. I love those principles. If our listeners have any things that they would like to add to our list, we'd love to hear them. Shoot us an email at
Well,
info@srbadvisors.com.
this is all an evolving process too,
Yeah,
trying to distill these
sure.
things down to the basics. So
That's
yeah,
right. That's right.
maybe
Um, not saying that we'll add them to our list, but we'd love to
no,
hear them, right?
no, right.
So, with that being said, Dave, appreciate the time today, and we will talk to you soon, my friend.
Thanks, Nick.
This is a Zedia Media production.